जी हाँ, ਤੁਸੀਂ ਦੇਖਦੇ ਹੋ ਅੱਜ ਕੱਲ ਅਮਰੀਕਾ ਸਾਂਝੀ ਸੋਚ ਟੀਵੀ ਤੇ ਮੇਰਾ ਨਾਮ ਇੰਦਰਜੀਤ ਕਾਲੀਰਾਏ। ਹੁਣ ਆਪਾਂ ਦਸੰਬਰ 25 ਤਾਈਂ ਪਹੁੰਚ ਗਏ ਆ। ਆਪਣਾ ਜਿਹੜਾ 20-25 ਸਾਲ ਸੀਗਾ ਇਹ ਖਤਮ ਹੋਣੇ ਤੇ ਆ ਰਿਹਾ। ਕਾਫੀ ਕੁਝ ਹੋਇਆ ਇਸ ਸਾਲ ਦੇ ਵਿੱਚ। ਜਨਵਰੀ ਦੇ ਵਿੱਚ ਅਮਰੀਕਾ ਦੇ ਵਾਈਟ ਹਾਊਸ ਦੇ ਵਿੱਚ ਡੋਨਲਡ ਟਰੰਪ ਆਇਆ ਸੀ। ਇਲੈਕਸ਼ਨਸ ਹੋਏ ਸੀਗੇ ਨਵੰਬਰ 5 24 ਦੇ ਵਿੱਚ। ਉਹਨਾਂ ਦੇ ਆਉਣੇ ਦੇ ਨਾਲ ਕਾਫੀ ਬਦਲਾਅ ਆਏ ਨੇ ਅਮਰੀਕਾ ਦੇ ਵਿੱਚ, ਔਰ ਉਹ ਬਦਲਾਅ ਦਾ ਇੰਟਰੈਕਸ਼ਨ ਬਾਕੀ ਦੁਨੀਆ 'ਚ ਵੀ ਹੋਇਆ ਹੈਗਾ। ਉਹਦਾ ਸਭ ਤੋਂ ਜ਼ਿਆਦਾ ਇੰਪੈਕਟ ਜਿਹੜਾ ਸੀ ਉਹ ਆਪਣੇ ਇਮੀਗ੍ਰੇਸ਼ਨ ਤੇ ਹੋਇਆ ਸੀ। ਹੁਣ ਕਾਫੀ ਹਾਦਸੇ ਵੀ ਹੋਏ ਸੀ ਪਿਛਲੇ ਸਾਲ, ਐਸੇ ਸਾਲ ਜਾਣੀ ਕਿ ਜਿਹਦੇ ਵਿੱਚ ਆਪਣੇ ਟਰੱਕ ਡਰਾਈਵਰਸ ਨੂੰ ਕਾਫੀ ਮੁਸ਼ਕਲ ਆਉਂਦੀ ਹੈ। ਬਟ ਦਸੰਬਰ 25 ਆ ਗਿਆ, ਜਨਵਰੀ 26 ਆ ਜਾਏਗਾ। ਜਨਵਰੀ 21 ਜਨਵਰੀ ਨੂੰ ਟੈਕਸ ਫਾਈਲਿੰਗ ਚਾਲੂ ਹੋ ਜਾਏਗੀ, ਜਿਹੜੀ ਈ ਫਾਈਲਿੰਗ ਹੈ। ਤੇ ਹੁਣ ਆਪਣੇ ਕਾਫੀ ਜਿਹੜੇ ਪਰਸਨਲ ਇੰਡੀਵਿਜੂਅਲ ਟੈਕਸ ਪੇਅਰ ਹੈਗੇ ਨੇ ਔਰ ਬਿਜ਼ਨਸ ਓਨਰਸ ਹੈਗੇ ਨੇ, ਉਹਨਾਂ ਨੂੰ ਕਾਫੀ ਰਸ਼ ਹੋ ਜਾਣੀ ਹੈ ਵੀ ਆਪਣੇ ਕਾਗਜ਼ ਪੱਤਰ ਇਕੱਠੇ ਕਰੀਏ, ਰਸੀਤਾਂ ਇਕੱਠੀਆਂ ਕਰੀਏ, ਖਰਚੇ ਆਮਦਨ ਤੇ ਟੈਕਸ ਫਾਈਲ ਕਰੀਏ, ਜਿੰਨੇ ਟੈਕਸ ਘਟਾ ਸਕਦੇ ਹਾਂ ਘਟਾਈਏ। ਔਰ ਇਹ ਸਾਰੇ ਜਿਹੜੀ ਬੁੱਕ ਕੀਪਿੰਗ ਅਕਾਊਂਟਿੰਗ ਦਾ ਹੈਗਾ, ਇਸ ਬਾਰੇ ਆਪਾਂ ਅੱਜ ਗੱਲ ਕਰਨੀ ਹੈ ਵੀ ਜਿਹੜੇ 25 ਦੇ ਵਿੱਚ ਫੈਡਰਲ ਗਵਰਨਮੈਂਟ ਨੇ ਲਾਅ ਪਾਸ ਕੀਤੇ ਨੇ ਔਰ ਡੋਨਲਡ ਟਰੰਪ ਕਹਿ ਰਿਹਾ ਸੀ ਦ ਬਿਗ ਬਿਊਟੀਫੁਲ ਬਿੱਲ, ਜਿਹਦੇ ਵਿੱਚ ਕਾਫੀ ਇਹ ਚੇਂਜਸ ਜਿਹੜੇ ਬਦਲਾਅ ਆਏ ਸੀ ਫਾਈਨੈਂਸ ਟੈਕਸਿਸ ਦੇ ਵਿੱਚ ਉਹਨੇ ਐਡ ਕੀਤੇ ਸੀ। ਉਹਦੇ ਬਾਰੇ ਆਪਾਂ ਗੱਲ ਕਰਦੇ ਹਾਂ ਹਰਜਿੰਦਰ ਗਿੱਲ ਨਾਲ, ਜੋ ਡਾਇਮੰਡ ਟੈਕਸ ਕੰਸਲਟੈਂਟਸ ਹੈਗੇ ਨੇ ਇੱਥੇ ਸੈਕਰਾਮੈਂਟੋ 'ਚ, ਯੂਬਾ ਸਿਟੀ ਉਹਨਾਂ ਦਾ ਆਫਿਸ ਹੈਗਾ। Welcome, Harjinder. We've done this once before when we talked about the big, beautiful bill. But right now, we're coming to December 31st when we say goodbye to 2025 and look back and see how good it was or how bad it was. And then we have to get ready for our taxes. So
Certainly.
let's do a little exploration of what we, the individual taxpayer, can be confronted with as a good thing or maybe a challenge come January 26. 21 is when I believe e-filing starts, and then we have until April 15th to get our taxes in. And if we don't, we have to get on our knees and beg for an extension. So anyway, give an introduction to Harjinder Gill, Diamond Tax Consultants, and then we'll do a little exploration.
Hello, my name is Tiger Harjinder Gill. I've been in the field of accounting and taxation for about 25 years. I worked as a tax professional and tax preparer, started off. I worked for the California State Board of Equalization as a tax auditor. I worked for the IRS as well. I worked for Aerojet Rocketdyne, Tie Truck Construction, and also started my own company, Diamond Tax and Financial. And
Okay.
furthermore, my education.
Mm-hmm.
My education consists of I graduated from Sacramento State University with a Bachelor's of Science in Accounting. And I further extended my education with a Master of Science in Accounting in taxation from Golden Gate University. And then I got a second Master's in Accounting and Data Analytics and AI from Golden Gate University as well.
Okay. Well, I know you're qualified, and just as a side note, you've been helpful in some tasks that I had to get done, so I appreciate that. With the experience that you have, from a novice taxpayer or a first-time taxpayer, somebody who just graduated high school or graduated college and got their first job and is going to be looking at filing their taxes, maybe they want to try the online method or something, they're going to be confronted with a lot of terminology, and we have a lot of abbreviations and things like that, which is standard language for you, but it's mind-boggling for somebody like me. But before we get too deep, one thing I know, there's a thing called a standard deduction. What is it?
Mhm.
How does it work? And how does it benefit me?
So the standard deduction is there's two types of deduction. One's a standard deduction, one's an itemized deduction. So standard deduction is what most Americans use. So it's pretty much is depending on what your filing status. Are you single? Are you married, filing joint, head of household? So those are different filing status or married filing separate. So pretty much what it is uh, like say for example, if you're a single filer, your standard deduction is 15,750. So itemized deduction is a combination of mortgage loan interest, your DMV fees, it includes your healthcare costs out of pocket. Also includes your property taxes. If that is more than your had a standard deduction, you get that as a deduction versus a standard deduction. If your standard deduction is higher than your itemized deduction, then you did give you. So the standard deduction is for all American is pretty much used to make your standard it is to make your the standard deduction is now permanent and starting in 2025. So pretty much in other words, your standard deduction is what you can pretty much based on your taxable income, adjusted gross income. You can subtract that from your adjusted gross income, your standard deduction. For example, in 2025, your standard deduction as a single filer is $15,750. So, and then you have an itemized deduction. Itemized deduction is what is on your Schedule A. So it's a combination of healthcare cost, out of pocket, your real estate cost you paid, your DMV cost for registration fees, and your mortgage interest you paid. So that's usually the main one. So if your itemized deduction is higher than your standard deduction, then you will get the itemized deduction versus a standard deduction. If your standard deduction is higher than your itemized, then you usually will get the standard deduction.
Okay, what you mentioned in there was real estate expenses. Can we elaborate on that a bit? Only because there's a family that's just bought a house. So my assumption here is
Mhm.
that those expenses for buying the house would classify as real estate expenses, and that's maybe a
Yes.
one-time thing, or is it repetitive every year? Or I think I would need more education in that. That's what I'm saying.
Okay, sure. So pretty much your real estate taxes, all that. It's under the SALT deduction, which is state and local tax. So it's a combination of your real estate taxes, assessments you paid, um, any like Melrose tax. That's all included in state and local tax. And right now with the new big beautiful bill, the state and local tax, SALT deduction, other words, it's increased to 40,000. So it benefits a lot of states, like in high income states like California, Illinois, Texas, and so forth. States that have really high states that in which you pay a lot of high property taxes, and which you also have pay a lot in mortgage interest.
Got it. So basically, if you're a homeowner and you're paying
Mhm.
property taxes and you're paying local
Mhm.
fees or taxes like Melrose every year, or any
Mhm.
other fees just because you have a house, then those come in as your real estate costs for home ownership that you're paying to the county and the city and all that stuff. And your
Yes.
costs for buying the house, which may be one time expenses, do they come into this too?
No, it's just the mortgage interest that usually comes in.
Okay,
Um,
got it.
the cost, if you're like, that's mostly for like, if you want to deduct the business cost, that's only if you're like taking you have a home, a secondary home, like a rental property, you can deduct that on your Schedule E. To
Okay.
depreciate that over a 39 year period.
Right. I think what I was asking on is if I'm buying a house today and I'm paying the fees
Mhm.
for the title company, the mortgage fees, Are they deductible one time, or can I roll them over every year? And
Yeah.
I'm
So
only
fees
buying
that
one
you
house.
pay,
I'm not
you
looking at rental.
for your primary residence, yes, you can write off like any fees, premiums you paid, closing costs. You can write that on your Schedule A, and you can deduct as long as you have valid documentation to support that.
Okay, so basically, your closing documents from the title company that you get at the end of the signing your house and getting your keys, that's a vital piece of information that you need to give to your CPA, your tax preparer, so you can get all those deductions. Got it. Uh,
Certainly.
you mentioned SALT deductions. A few years ago, there was a lot of talk on that, and I believe that was in Trump 1.0 when they were talking about limiting the so-called local and state taxes to
Mhm,
a cap, and to address,
mhm,
basically, it was to entice states with higher taxation to respond to
mhm,
residents who own homes and who are being taxed out of their homes technically. Now, what you said, they've
mhm.
raised that cap on there. And so, first of all, the SALT deduction is in your federal taxes, it's not in your state taxes. Am I correct there?
Correct. Yes.
Okay. So, and this is an annual thing for whatever property taxes I pay on my house, and
Yes.
any fees for mellow roofs or lighting streets and fire department
Mhm,
assessments, anything that the city or the county can come up with, I can claim those
mhm.
there. Okay, is that
Yes.
separate from the DMV fees I pay for my car?
No, just included with the schedule. It's on your Schedule A. It's separate. Salt deduction is separate, but it's all included on your Schedule A.
Okay, so they're both under the SALT deduction category, but two
Mhm.
separate items.
Yes.
Um,
Mhm.
I can deduct my property taxes on my house that I pay. Can I deduct my homeowner's insurance?
Not the homeowner's insurance. We can't, unless you're in a trade or business, or unless it's a rental property.
Okay. And same for DMV fees and auto insurance. I can deduct my DMV fees, but not my auto insurance. Unless,
No.
again, I'm running a business.
Yes, unless you're under Schedule E.
Got it. And just before these sold, we talked about the standard deduction. This big, beautiful bill, how did that change? What was it before the big, beautiful bill? And what is it like going to be for the 25 taxes?
So the big beautiful bill is from tax years 2025 to 2028. Like I said, as we speaking of the salt deduction, it goes from 2025 to 2028, and then the salt deduction, how is 40,000 capped at 40,000 per year. It's going to, after 2029, it's going to be capped at 10,000. So it's really a lot of like benefits that we have with this big beautiful bill, especially with high people in high income tax brackets or high earners with cost of living going high, especially in the state of California. It's really beneficial for us, including not just California, but states like Illinois, Connecticut, New Jersey, Vermont, Texas, Ohio, New York, and Wisconsin.
So when you say that this SALT deduction is from 2025 to 2028 tax filing years, there's a
Mhm,
sunset on this. So when the sun sets in tax filing year 28, the SALT deduction drops
mhm.
back to 10,000 unless
Yes, after
Congress acts on it.
2029. Yes,
Okay, so
correct. And
2029, we're going to have a big discussion and media event about how the Congress will not get together, just like we had this year about the shutdown and agreeing on passing this and passing that. So 29, we're going to have this issue about taxing people. If you drop it down from 40 to 30, that can have a large impact on taxes we pay.
yeah, so pretty much it takes you from a lower paying income tax bracket to a higher income tax bracket. So the extra 10,000 makes a quite different difference for a lot of Americans.
Because that from 40 where it's going to be for this year down to back to
Mhm.
10 is a $30,000 deduction.
That's
And
huge.
that can impact your tax filing status. Yeah. Okay. Um, what changes have happened in this mortgage deduction that we can take in our taxes? Uh, have they increased that cap, or is it still the same? Or what's the rules on
So
that?
that's so the mortgage interest deduction is included with um, the SALT deduction. So it's all on the it's all part of on the Schedule A. So the cap,
Mm-hmm.
it was we had a mortgage cap of 750,000, but now with the $40,000 like SALT deduction, it's really great. And the thing is, that this SALT deduction also phases out if your taxable income exceeds 500,000. So if once a year get to closer to 500,000 of taxable income as husband and wife, it starts going down. But once you hit 600,000 as taxable income, it completely goes away.
So the salt uh, deduction that we can take, it's only up to 500,000 taxable income, and at 600 you
Correct.
get nothing. So
Yeah, it
okay
then phases
then.
out. The SALT deduction goes away.
Okay. So according to the big beautiful bill, this salt deduction that we're going to get for tax filing year 25, it goes from the current 10,000 to the 40,000. And that
Yes.
is only if our taxable income is less than 500,000. And then if our
Yes.
taxable income is 600,000, the SALT deduction doesn't even apply.
Correct.
We get zero.
There.
Okay. Um, you mentioned 750. Is that the size of my mortgage? That is,
Yeah, the
what's
mortgage.
that number for?
That's a new provision they made with the big beautiful bill. So they kept it 750,000 for the mortgage, your mortgage loan you take up. So if you pay buy like $1 million home and you say you put a down payment of 250,000, the cap on your mortgage can't be more. Your mortgage loan can't be more than 750K.
So up to 750,000 mortgage on my primary
Mm-hmm.
residence, I can
Mm-hmm.
deduct the interest I pay to the mortgage company. What happens if it's
Mm-hmm.
more than 750?
And then it starts put the deduction, it starts slowing down, starts getting decreasing or shrinking little by little as it phases out.
Okay, so if I get a $1.5 million house and I have $1 million
Hmm.
mortgage, am I
Hmm.
shrinking on the 250 above 750, or am I shrinking on the whole mortgage of $1 million?
Of the whole mortgage.
So what I can deduct on the interest, it starts going lower the bigger my mortgage.
Correct.
So is that a percentage?
No, it's not percentage. It's by dollar for dollar. As I haven't really seen it much happen, but what it is the higher the mortgage, the less of the deduction you will get. And this is more for like middle to low income to middle class families. So the higher the mortgage, the less incentives you get as a high if you're in the high income tax bracket.
I can understand the numbers associated with this, but for our viewers, listeners, our families, and our friends living in Los Angeles area, or in San Diego, or in the Northern California Bay
Hmm.
Area, as we call it, you can't even
Hmm.
find a house under $1 million, and that's a condo. If you want a single family home, you're looking at the 2 millions, and trying to
Hmm.
get a 20% deposit to put down on that is a significant hurdle, and your mortgage is most likely to be in the 1.7 million, not the 750,000, unless of course you work for Google or Facebook or Meta and maybe some other of those AI startups. If you're working for sort of Safeway, you're probably not
Mhm.
going to be buying a house in the Bay Area. But if you're able to buy a house in Fremont, San Jose, Milpitas, and all those other places, most likely you're going to have a mortgage about 1.5 over or slightly under,
Mhm.
depending on the type of house you buy. So I personally can't classify these people as necessarily being middle class or the higher upper echelon rich people. That's normal life for
Mhm.
them. And we live in
Yeah.
Sacramento. A decent house here is
Mhm.
now hitting the $1 million mark.
Easy.
So I don't think
Easy.
anybody who lives in a $1 million house is rich.
No, no. Yeah. So what happens is like a lot of taxpayers, what they do, they'll instead of buying, they will just rent out the property because it makes more sense. And then, like say, they also have a lot of lease to own options. So after 2 years of paying the mortgage or paying the rent, they have an option to even buy the purchase property when, like, say, the market will tank. They'll right straight up just buy the property or buy the residence.
Yeah, so that's just creative means of trying to buy something and get your foot through the door to home ownership. Um, it's
Exactly.
interesting concept, but how these politicians classify wealth is
Hmm.
mind-boggling because even though they themselves accumulate significant amounts of cash, they classify the normal voter as being
Yes.
middle class or rich or upper class, whatever they want to call it. And if you really look at the individuals who have to go through daily life, $1 million house does not put you in the category of rich. 10 years ago, 15 years ago, maybe, but not today. Anyway,
Okay.
there's another thing on the taxes when we're filing as individuals, and it's called charitable expenses. Can you define what a
Mhm.
charitable expense is?
So charitable expenses are like expenses that you do for it's like when you're donating to like a charity. It's pretty much is like for cash, like nonprofits, something like say church, like this like Salvation Army, like those like those type of charitable organizations, and they have a new rule where if they will give you like up to you get a automatic charitable contribution of 1,000 for a single filer and 2,000 as a married filing joint filer. And they have that, and that is a um, new incentive with this big beautiful bill. And they also have if you also have non-cash as well charitable contributions, which is also a new thing as well. People actually, if you're donating clothes or like non-cash items, that's another one that a lot of taxpayers are not familiar with.
Okay. Um, does that mean if I'm going to the local Gurdwara every Sunday and I do my matha take, can I deduct that?
Uh, so if you make a charitable contribution, like you donated like cash, donate like a donation to public charity, whether it's church, you get a receipt. Whether it's like uh like say L for Lupus, like charitable organization or foundation or Cancer Society, one of those. As long as you have a receipt for a cash donation, you can write that. You can also write that off as part of your Schedule A as a deduction. So this pretty much it is. It's like above the line deduction. So for single filers, you get $1,000 deduction. And for married filing joint, it's a $2,000 deduction.
Okay, so do I need receipts for this? Because
Yeah.
I, my impression is if I go to the local church and they pass around the collections basket for donating to the church, if I put 5, 10, $20 in that, I probably am
Mhm.
one of those people who wants to deduct that on my taxes.
Yeah. So pretty much, if you're a single taxpayer, you get $1,000 without any. You don't have to provide any proof of receipt. Usually 1,000. Anything over 1,000 as a single tax filer, then you will have to provide a receipt for as supporting documentation from like church or charitable foundation, wherever you give a cash donation. If you're merely filing joint, and you can deduct up to 2,000 without providing proof of receipt for your cash donation to the charitable organization.
Okay, so basically, something that at least you and I both can relate to. If we go to the Gurdwara, we do a Matha Teka or the Mandir, um,
Hmm.
that really doesn't count as a taxable deduction. But if we go down to the cashier and give him $50 or $10, then we get a receipt for it. That we can file with our taxes. Now, is that on that receipt we get from the cashier? Is that on top of the 1,000 or is it part of the 1,000?
Is part, so it could be part of the 1,000. So if it's under 1,000, then you don't have to provide a receipt. If it's over, as a single filer, if it's so less, sorry, for a single filer, if it's less than 1,000, you don't have to provide a receipt. Anything over 1,000, you do. And then same thing for a married filing joint. If it's under 2,000, you don't have to provide a receipt. Anything over 2,000, you will definitely have to provide a receipt.
Okay, so if I go to 1,500 in my deductions, then I need receipts for the other 500.
Correct.
Okay, all right. And so joint filers, we'd need receipts for over 2,000. So
Hmm.
if we did some function and we paid the Gurdwara or the local church to host an event, then that is a deduction, or is that just a expense?
It's a deduction.
Okay. So there are some things that we as individuals can, under the umbrella of charitable deductions, file when we generously give to the Red Cross or any other local charities. But if we're just walking by and we put a $5 into the Salvation Army, we can deduct it under a cash, no receipt, as long as it doesn't total more than 1,000.
Correct.
Okay, all right. Let's move on to family and dependents. What changes have happened this year on our family deductions for joint filers, uh, for children? Um, Give us an insight into that.
Definitely. For the new tax bill, we also have, like say for the child tax credit, we have it where you'd increase the child tax credit to 2,200 per child, long as the child is under 17. And the only thing threshold on that is if you have to be within the income limits of 200,000 as a single tax filer or 400,000 as a joint filer, and that's one thing. And they also have it where if you're in your kid your child or your is in after school program, or if they're in daycare, like say you have 6,000 in annual expenses, right? For your child. So 6,000, under the big beautiful bill, you can write half that off as a deduction.
So, if the particular kid is involved in a lot of extracurricular activities, after school activities, any expenses as a parent, involved in enrolling the kid, taking them to those activities, or is it just the participation fees? Or if I'm driving my
It's
kid
just
to play soccer on a Saturday morning, they have a match not in Sacramento but in Modesto, and I have to drive my child there. Do I get the deductible on that for the travel
no.
expenses?
So if it's any after school activities or childcare services, like daycare or whatnot on those, then those are deductible 50% of what you pay annually,
Okay, so
as long
not
as you have supporting
extracurricular
documentation.
activities like being part of the football club or something like that, and not traveling to
No,
those sporting events. Okay, okay, all right. Childcare, daycare, after school care. What about
yes.
tuition needs?
Tuition needs are also included in that as well. And like say your child needs tutoring for subjects in school like math, science, English, whatnot. There's definitely deductible as long as you have substantial proof or evidence to support that.
Okay, so if you're tutoring my child in mathematics, I would need a
Mhm.
written receipt from you that we have this agreement for you to be providing tuition to my child
Correct.
and the fees that we exchange money for. Okay. Um, you mentioned a child up to the age of 17, but kids are normally in school until 18. Why
Mhm.
17?
Because this is also based on the earned income tax credit as well. It's a similar thing, where if you're under 17, you can also get the earned income tax credit, long as you meet certain thresholds of your taxable income. So that's why it's pretty much this is where it's an extra incentive. So you get like as to be under 17, anything once you're 18, you the child is an adult and you can no longer take the deduction.
Okay, so I've got a 12th grader, 18 years old, is now going to go to college.
Mm.
Do I get there once they get to college? Are they still on my tax filing?
They could be you can keep them on your as a dependent, but you won't get the earned income tax credit or child care credit. Only thing is, you can still claim as a dependent, but as the older your child gets over 18, or even if they're living with you up to age 23, you can get a deduction, but it won't be as much. It kind of decreases
Okay. Now, what
year by
about
year.
these children who get part-time jobs? Um,
Yeah.
do they file that part-time job income on their parents' taxes, or do they file their own?
Depending on the circumstances, if the child is a student and he earns a very small amount, then you can claim them as a dependent. If they earn X amount and you don't go to college, then what you could do is have them file their own personal tax return.
So, is there a cap on what a child can earn before, so that you can deduct
You,
or claim their income on your taxes before they you have to be told to go file their own?
so usually the phase out, I believe, is around 12,000, but
Okay.
don't quote me on it. I can remember, but if it's under that amount, then you can claim as a dependent. If you're only working the summer, let's say, then it's understandable. I'd rather claim my child. But if they've been working year round and not going to college and they're not a student, then it's more beneficial for your child to file their own personal tax return.
Okay. Okay. And what about tuition fees? How do they relate? Um, we're talking on the child being over 18. They're going off to college. They have
Mhm.
tuition fees, or even if we send our child to a private school instead of the
Mhm.
public school, are those fees deductible?
Yes, those, as long as you have a 1098 T, it's meant by the university, you can write that, and you can include room and board, books, um, uh, room and board, books, any other like tuition costs that are related out of pocket. You can include that as well, as long as you got supporting documentation, receipts, and a 1098 T submitted from the university.
Okay, so I mean, using a Sacramento example, there's a couple of private K through 12 schools. Many of our parents locally put their children in those schools because they can afford to, is one reason, and the other is they're not too happy about California's regulations and requirements for schools that are public schools, specifically the curriculum and other categories, which we won't cover, we won't go into. But as a parental choice, these school children go to a private kindergarten, high school, so those fees are also deductible.
Yes, the deductible, long as we have supporting documentation, and receipts and whatnot, and then we can write that as well. And you get deduction based long as the student is full time, and they're also you know in their for if they're in a private school, that's you'll receive a different statement. You can write that off entirely. And if you're in college and you get a 1098 T, you can write that off entirely. Correct.
Okay. Um, I think mostly something for personal taxes. We've covered home ownership. Um, we've covered individual taxes. As a homeowner, beyond my mortgage and property taxes, if my AC breaks down and I have to repair it, can I deduct that?
No, part of
Okay.
personal
So
expenses,
home
part of living
repairs
room
and
and thing.
landscaping are not deductible.
Yeah, you're only deductible under Schedule E or rental property.
Okay, got it. Um, I think we've covered quite a bit of ground for this time we've had. Is there anything additional that I might have missed in asking you?
Yes, I would like to go over the new senior bonus deduction. So if
Okay.
you're a senior and your age is 65 and older, you can get an extra deduction. And on top of your standard deduction, what your standard deduction it is for single filers 15,750, and if you're married, is 31,500. So as a single filer, as a senior, you get an extra $6,000 deduction. So as a single filer, as a senior, age 65 or older, your deduction goes from 15,750 to 21,750. And if you're a senior filing joint, your standard deduction goes from 31,500 to 43,500.
Now, is that a big, beautiful
As long
bill
as
feature, or has that always been there?
it's just a new feature starting in 2025. So
Got
pretty
it.
much it is, as long as your modified adjusted gross income is 75,000 or less as a single filer, or 150,000 or less as a married filing joint filer.
Okay, so as a senior, individual filer or filing joint, I or whoever this person is will get 6,000 on top of their standard deduction, and if they're a couple filing jointly, they get 6,000 each, which becomes 12,000 on top of their standard deduction. Okay,
Correct.
and that's from this big beautiful build, and this feature was not there before. Okay, thank you.
Correct.
Anything else?
And we also have another one that's really big. It's a car loan interest deduction. So
Okay.
for the first time, but Donald Trump is really creative. He created one where individuals can deduct up to $10,000 per year in auto loan interest. This deduction is valid from tax years 25 to 2029, only on new U.S. assembled personal vehicles. It's an above the line deduction. And the phase out starts at $100,000, 100,000 income for single filers and 200,000 for joint filer, married filing joint filers. The significance of this deduction for consumers is now middle income class families financing a new car could save hundreds of dollars annually. However, excludes used vehicles and it also excludes higher income households, so it's narrowly targeted.
Okay. So if I get that right, if my income is less than 100,000 as a filer, I can also then deduct a car interest on the loan I take out to buy the car, up and the interest amount being up to 10,000.
Correct.
Okay. What if I already have a car? I bought it last year.
No,
Can I deduct
the
that
car
interest
has to
this
be
year?
brand new. If it's
Okay, so I
no,
have to buy
if
the
it's an old
car
used,
in 2025.
brand new.
So I need
Yeah,
to
it's a
go to
brand
the
new
dealership
vehicle.
right now.
Yes.
Okay. All right. All right. So we've covered two new features then that this big, beautiful bill brings in. One is the seniors uh, addition of $10,000 onto their, oh no, $6,000 onto their standard deduction. And then $10,000 of auto interest on a new car purchased, which is at least assembled in the US,
Correct.
right? Okay, and then this also will phase out in 29.
2028. End of 2028.
So we will be able to claim it up to 2028 tax filing year, but then it's gone for
Correct.
2029. So then we have the same ongoing legacy issues where we have Congress having to pass legislation to extend it or whatever. So the sunset hours that they put in some of these provisions is always creating this loop where Congress gets our attention. But in the
Mhm.
interest of time, I think we've covered quite a bit. You've added items that I did not know, which is the seniors and the auto tax. So thank you on that. Um,
Yeah.
I think we'll take a break for today. I thank you for your time. And I hope people found this information useful because there are some good changes coming in for 2025 tax filing come January. So useful information, and thank you for that. And we'll join up again in the near future to talk about business and what changes we have for businesses. So look forward to meeting you again. Thank you. We were talking, this is Aaj Kal America, Sanjhi Soch TV. We were talking to Harjinder Gill from Diamond Tax Consultants here in Northern California. Uh, we learned about the new changes coming for the tax filing season for 2025, which starts electronically online filing for January 20th, 21st. Get your papers ready, get your numbers ready, and be ready to file for 2025. And if you need any questions, you can obviously reach out to Harjinder. He's a CPA and a tax preparer. Very helpful, very useful information, very approachable. Um, Give us leave for today, and we'll join you back again for another session very soon. Aaj Kal America, Sanjhi Soch TV. Thank you.